Cryptocurrency regulations, navigating the evolving landscape of digital assets. Welcome to CryptoQuest. The cryptocurrency market, which was previously distinguished by its decentralized, free-flowing nature, is currently enduring a substantial transformation as governments and institutions worldwide clarify their stances on digital assets. The ecosystem is being reshaped by regulatory updates and pronouncements, which are having an impact on investors, developers, and businesses that operate in this dynamic sector. This video explores the most recent regulatory developments, their implications for the cryptocurrency market, and the both opportunities and challenges they present to stakeholders. The present state of cryptocurrency regulation. The financial landscape has been transformed by cryptocurrencies, which pioneered decentralized, transnational, and transparent transactions. Bitcoin and Ethereum are prominent examples of this. These digital assets are expected to facilitate increased financial inclusion, reduce transaction costs, and introduce innovative applications such as non-fungible tokens (NFTs) and decentralized finance (DeFi). However, their disruptive potential has also resulted in substantial challenges that have captivated the attention of governments and financial regulators globally. The promise and peril of cryptocurrencies, a dual nature. Innovation. Guarantee. Cryptocurrencies present unparalleled opportunities to revolutionize financial systems. Their decentralized nature establishes new opportunities for economic activity, promotes financial sovereignty, and eliminates intermediaries, particularly in underserved regions. Apprehensions voiced. Cryptocurrencies have provoked apprehensions in critical sectors despite their potential. Financial stability. Traditional financial systems are at risk, particularly in economies with high adoption rates, due to rapid market volatility and speculative trading in cryptocurrencies. Consumer protection. Numerous retail investors have been rendered vulnerable by the proliferation of hacking incidents, schemes, and unregulated exchanges. Users frequently experience a lack of legal recourse in the event of fraud or loss due to the absence of distinct regulations. Prohibited activities. The pseudonymous nature of cryptocurrency and the absence of centralized supervision have led to its association with money laundering, tax evasion, and the dark web. The call for regulation. The objective of regulatory initiatives is to promote innovation and address these concerns. Nevertheless, the approaches employed by different countries are highly diverse, reflecting their economic priorities, political attitudes, and technological capabilities. 1. Managing innovation and oversight. The challenge for policymakers is to establish regulations that safeguard users and reduce risks without impeding the expansion of blockchain technology and digital assets. The sector's long-term sustainability is contingent upon the attainment of this equilibrium. 2. Global responses. That are distinctly fragmented. A patchwork of approaches has been established as a result of the absence of a unified global regulatory framework. Certain countries, such as El Salvador, have fully incorporated cryptocurrencies by recognizing Bitcoin as legal tender. Others, such as China, have implemented stringent prohibitions on mining and trading, thereby promoting the creation of state-controlled digital currencies, such as the digital yuan. A third group, which encompasses regions such as the European Union and Singapore, aims to establish comprehensive frameworks that promote innovation while regulating the market. The importance of regulatory clarity. Regulatory clarity is becoming increasingly important as the cryptocurrency market matures. It guarantees long-term confidence in the market by providing stability to businesses and investors. The sector is legitimized by the establishment of clear guidelines, which attract institutional investors and encourage traditional financial institutions to engage with digital assets. A safer ecosystem for adoption is established by robust regulations that protect consumer rights and reduce fraud. Governments and institutions are transforming the cryptocurrency market into a more secure and inclusive financial system for the future by addressing the opportunities and risks associated with digital assets. Global overview of regulatory approaches. 1. United States. The U.S. Securities and Exchange Commission (SEC) has intensified its examination of cryptocurrencies, with a particular emphasis on the determination of whether specific tokens constitute securities under federal law. The interpretation of securities laws in the context of digital assets is being influenced by high-profile litigation, such as the SEC versus Ripple case. Second, European Union. The markets in crypto assets. MiCA regulation has been implemented by the EU to enhance its regulatory framework. The regulation is designed to harmonize cryptocurrency regulations across member states, thereby assuring investor protection and fostering innovation. MiCA addresses a variety of issues, including anti-money laundering AML compliance, crypto asset service provider CASP licensure, and stablecoin governance. 3. China. China has implemented a rigorous policy, prohibiting the trading and mining of cryptocurrency and prioritizing the development and adoption of its own CBDC, the digital yuan. 4. India. India continues to exercise caution, proposing high taxes on cryptocurrency gains and investigating the implementation of a digital rupee. The government has not yet completed the development of its comprehensive regulatory framework. 5. Other notable regions. Certain countries, such as El Salvador, have adopted cryptocurrencies as legal tender, with Bitcoin serving as an example. Switzerland and Singapore are establishing themselves as crypto-friendly centers by providing transparent regulatory guidance and tax incentives. Principal trends in cryptocurrency regulation. 1. The emergence of central bank digital currencies, CBDCs. Governments are investigating CBDCs as a means of modernizing payment systems and preserving monetary control. These digital currencies, which are issued by central banks, are frequently perceived as a direct response to the proliferation of decentralized cryptocurrencies. 2. Emphasize stablecoins. Stablecoins, which are linked to fiat currencies or other assets, are currently under regulatory scrutiny as a result of their potential influence on financial systems. The objective of regulators is to guarantee that these tokens are transparent and adequately supported in order to mitigate systemic risks. 3. Requirements for anti-money laundering AML and Know Your Customer. KYC. Crypto exchanges and service providers are being compelled to establish more stringent AML and KYC protocols. The objective of these measures is to reduce the prevalence of illegal activities, including money laundering, fraud, and terrorist financing. 4th, policies. Regarding taxation, governments are implementing more stringent tax reporting requirements to guarantee that cryptocurrency trading profits are taxed appropriately. Capital gains taxes that are specifically designed for digital assets are being implemented in certain countries. The Fifth International Monetary Fund (IMF) and the Financial Action Task Force (FATF) are advocating for global standards to regulate cryptocurrencies, acknowledging their transnational nature. Consequences of regulatory changes. 1. Investors. Positive. Investors can benefit from clear regulations, which can create a safer environment, reduce fraud, and increase trust in the market. Unfavorable. The profitability of merchants and long-term holders may be diminished as a result of increased compliance requirements and taxation. 2. For businesses. Companies that operate in the cryptosphere, such as exchanges, wallets, and DeFi platforms, are subject to increased operational costs as a result of regulatory compliance. Institutional investment can be facilitated by regulatory clarity, which in turn promotes market growth and innovation. 3. For developers. Developers must modify their projects to comply with regulations, particularly those related to token issuance, decentralized finance DeFi protocols, and privacy features. Jurisdictions with more stringent regulations regarding anonymity and decentralization may present obstacles to open-source projects. Difficulties in regulating cryptocurrencies. First, regulation and innovation in balance. It is imperative that governments maintain a balance between the promotion of innovation and the protection of security. Under-regulation may result in market instability, while over-regulation has the potential to stifle development. Second, global coordination. The effective enforcement of regulations by individual countries is rendered difficult by the fact that cryptocurrencies operate across borders. Global cooperation is indispensable. However, it is exceedingly challenging to execute. 3. Complexity of technology. The capacity of regulators to comprehend and legislate blockchain technology is frequently exceeded by its rapid progression. Fourth, privacy versus consumer protection. Efforts to safeguard consumers frequently conflict with the crypto ethos's fundamental principles of privacy and decentralization. Enjoyed the content? Don't forget to like, subscribe, and leave a comment below to share your thoughts. Your support keeps us going.